Welcome back to the deep dive. This is where we pull back the curtain on some complex topics and try to boil them down into something really useful. Today, we're digging into something that honestly can feel a bit opaque on a company's financial statements, even though it's super important. We're talking about the statement of retained earnings and the bigger picture, the statement of stockholders' equity. And this isn't about getting lost in accounting jargon. Think of these statements as telling a really powerful story about a company's financial health, its history, maybe even its strategy. So, our mission today: cut through the fog, pull out the key insights, and basically give you a shortcut to really understanding this crucial piece of the financial puzzle.
Okay, but before we dive deeper, just a quick reminder. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations, they're derived from the fantastic accounting resources over at farhatlectures.com. So whether you're an accounting student prepping for the CPA exam or already a professional, definitely check out the website.
They've got extra practice questions, video lectures, tons of support to really nail down what we talk about today. A big thanks to Professor Farhat for making this material available. All right, let's unpack this. Starting with retained earnings. Fundamentally, what are we actually talking about here? Why is this number so basic yet so important?
Right. Think of retained earnings as like the company's long-term savings jar. It's essentially the grand total of all the profit a company's ever made, going way back,
Yeah.
minus any of that profit it's already paid out to the owners, the shareholders, as dividends.
Ah, okay, so it retains the earnings.
Exactly. That's why it's a cumulative account.
Yeah,
Doesn't reset each year. It just keeps building or sometimes shrinking year after year.
got it. So it's not just this year's performance, it's a historical accumulation. That already makes it sound like a record of past decisions. What makes this savings jar go up or down, typically?
Precisely. It is a historical record. And the two main levers are pretty straightforward: net income and dividends. When the company turns a profit, makes net income that gets added to the retained earnings balance. That's the main way it grows.
Makes sense. Profit boosts the savings.
Yep. And then conversely, when the company decides, okay, let's give some of this profit back to our owners, usually as dividends, either cash or sometimes stock, that distribution reduces the retained earnings.
So profit comes in, dividends go out. Seems like there should be a fairly simple calculation then.
There is, and it's quite elegant, really. You take the retained earnings balance, you started the period with the beginning retained earnings, you add the net income earned during that period, then you subtract any dividends paid out during that same period, and boom, that gives you your ending retained earnings. It's simple, but, the story it tells can be quite complex. Are they reinvesting heavily, or are they focused on returning cash to shareholders?
Okay, let's make this really concrete. Using an example from the source material helps. Say a company kicks off the year with $50,000 in retained earnings. They have a good year, make $30,000 in net income, but they also decide to pay out $10,000 in dividends to their shareholders. Walk us through that formula. What's the ending balance?
Sure. So start with the $50,000 beginning balance. Add the $30,000 net income that brings it up to $80,000. Then subtract the $10,000 paid out in dividends. So their ended retained earnings balance is $70,000.
$70,000, okay.
And crucially, that $70,000 ending balance for this year, that becomes the $70,000 beginning balance for the next year. It just keeps rolling forward, showing that cumulative effect.
Right, that continuous story. But financial stories aren't always neat and tidy, profit in, dividend out narratives. Sometimes things pop up from the past. This brings us to something really interesting. You mentioned, what if a company finds out they made a mistake, like a significant one, in a previous year's accounting? How does that mess with retained earnings now?
Yes, this is where it gets a layer deeper. While net income and dividends are the usual suspects, retained earnings can also be directly adjusted for specific things. And the big one, the most common you'll see, is correcting errors from prior periods.
Prior period errors. Okay.
Yeah, we're not talking about just like a small typo. This could be a miscalculation, maybe misapplying an accounting rule, something that actually impacted the reported numbers back then.
So if they find an error that affected, say, last year's revenue or expense, why fix it through retained earnings now? Wouldn't they just, I don't know, go back and change last year's statement? I guess those books are closed, right?
Exactly. You hit the nail on the head. Those prior year books are closed. The revenue and expense accounts from that year were already zeroed out, and their net effect, the profit or loss, was already closed into retained earnings back then.
Ah, okay. So the impact already landed there.
Precisely. You can't really go back and reissue last year's income statement easily. The cumulative effect of that old error is already sitting within the retained earnings balance. So to make the current financial picture accurate and reliable, you have to make the correction directly to the beginning balance of retained earnings for the current period. It's transparent, showing, hey, we found this issue from the past and we're fixing it now.
That makes perfect sense. The cumulative account has to absorb that past correction. Can you show us how that looks with numbers using our earlier example, maybe?
Absolutely. Let's stick with that scenario. We started with a $50,000 beginning balance. Now, let's say the company discovers an error from a prior year. Maybe they found out an expense was overreported by $5,000. They recorded too much expense back then.
Okay, so if expense was too high, profit was too low.
Exactly, which means their retained earnings were understated. So to correct this, we need to increase retained earnings. We take that initial $50,000 beginning balance and we add a $5,000 adjustment for the prior period error. That gives us an adjusted beginning retained earnings of $55,000.
Right, starting from a corrected point.
Correct. Then you proceed as usual. Add the current year's $30,000 net income, subtract the $10,000 in dividends. $55,000 plus $30,000 is $85,000. Minus $10,000 gives you an ending retained earnings of $75,000. Compare that to the $70,000 we got without the adjustment. Is a significant difference.
It really is. Wow, that highlights how these adjustments aren't trivial. So besides fixing past mistakes, are there other, maybe less common things that might directly adjust retained earnings?
Well, the source material hints at a few other possibilities, though they're often less frequent for many companies. Things like adjustments related to selling treasury stock at a loss could potentially impact retained earnings directly in some cases. The main point, though, is that retained earnings acts as this sort of catch-all account for the accumulated results of operations and certain direct adjustments over the company's life.
Okay, that's clear. Now, let's shift gears slightly. So a company builds up this pot of retained earnings, this accumulated profit. Does that mean management can just, spend it however they want, like declare massive dividends anytime? Or are there sometimes strings attached?
That's a great question, and the answer is often no. It's not entirely free rein. There can definitely be strings attached. Portions of retained earnings can be restricted, or sometimes called appropriated. This means that part of the balance isn't available for general use, like paying dividends.
Restricted? Why would that happen?
There are a few main reasons. First, legal requirements. Some industries, banking is a classic example, might be legally required to keep a certain minimum level of retained earnings as a cushion for stability.
Makes sense for banks. What else?
Second, contractual obligations are very common. Let's say a company takes out a big loan. The lender, like a bank, might put a clause in the loan agreement, a covenant saying the company must maintain retained earnings above a specific amount, maybe, say, $1 million.
So the bank is protecting its loan.
Exactly. They want to ensure the company keeps enough internal funds to service the debt and doesn't just pay everything out as dividends, leaving the company potentially vulnerable.
Okay, so legal rules, bank rules, anything else. Can a company restrict itself?
Absolutely. That's the third category. Internal decisions. Management or the board might decide to earmark a portion of retained earnings for a specific strategic purpose. Maybe they're planning a major factory expansion in a few years and want to set aside funds. Or perhaps they want to limit stock buybacks to prioritize paying down debt.
So it's like putting a label on part of the savings jar. Reserved for Project X or do not use for dividends.
That's a perfect analogy. These restrictions, whether legal, contractual, or internal, give you really valuable insight into the company's obligations, its constraints, and its strategic priorities.
Fascinating. Okay, so we've got a really good handle on retained earnings now, the basics, the adjustments, the restrictions. But you mentioned earlier, so it's just one part of a bigger statement. What's this broader view, the statement of stockholders' equity? How does retained earnings fit into that?
Right, so the Statement of Stockholders' Equity, you can call it the SSE, is the comprehensive picture. It's the umbrella statement. The Statement of Retained Earnings, which we just discussed in detail, is actually just one column or one component within the SSE.
Okay. So what else is under that umbrella?
Well, besides retained earnings, you typically have columns for common stock that represents the basic ownership shares and their par value, the initial stake. Then you have additional paid-in capital, sometimes called APIC. That's the money investors paid over and above that par value when the shares were first issued.
Right, the premium paid.
Exactly. And then, depending on the company and the complexity, you might also see a column for Accumulated Other Comprehensive Income, or AOCI. That one's a bit more advanced, but It captures certain gains and losses that bypass the regular income statement but still affect overall equity. Things like foreign currency adjustments or changes in the value of certain investments.
Wow. Okay. So definitely more moving parts than just retained earnings. The SSE tracks changes in all of these equity pieces.
Precisely. That's its job. It shows you, line by line, how each component of equity changed over the period. It details the impact of net income and dividends on retained earnings, just like we discussed.
Oh,
But it also shows how issuing new stock increases common stock and additional paid-in capital, or how buying back treasury stock transactions might decrease those accounts and potentially retained earnings too. It connects all the dots.
so it's a reconciliation of the entire equity section from the beginning of the year to the end.
You got it. It provides that complete, holistic view of everything that caused the owner's stake in the company to change during that period.
Let's try to visualize that with the example from the source material. We don't need every single number, but conceptually, how does it lay out?
Okay, so imagine a table. Across the top, you have columns: common stock, ABT, retained earnings, maybe AOCI, and then a total equity column. You start with a row showing the beginning balances for each of those columns. Let's say $100K common stock, $50K APP, $50K retained earnings, $10K AOCI.
Got the starting point.
Then you have rows for the activities during the year. If they issue new shares, you'd see increases in the common stock and APIC columns. Then a line for net income, which only increases the retained earnings column and the total equity.
Right. Income flows to retained earnings.
Then a line for dividends, which decreases the retained earnings column and total equity. And if there were changes in AOCI, you'd see that reflected in this column and the total. Finally, you sum down each column to get the ending balances. The beauty is seeing how each distinct activity impacts its specific part of equity, all rolling up to the final total equity figure.
That really does bring it all together. You see the retained earnings changes we focused on, but placed in the context of everything else affecting ownership. Fantastic. Okay, time to see if this is sinking in. Let's try a quick knowledge check question straight from the Farhat Lectures material. Ready?
Let's do it.
In which of the following statements are prior period adjustments reported? And your choices are A, the balance sheet, B, the multiple-step income statement, C, the statement of cash flows, or D, the statement of retained earnings. What do you think?
Based on our discussion, it has to be D, statement of retained earnings.
Correct. And remind us again, why is that the right place for those adjustments?
Right. It circles back to what we said earlier. Those prior period errors usually relate to revenues or expenses from a past year. Since those accounts were already closed out to retained earnings back then, the correction has to happen where the impact originally landed, which is the retained earnings account. So the adjustment itself is presented clearly within the statement of retained earnings, usually as an adjustment to the beginning balance. It makes the correction transparent.
Excellent explanation. And there you have it. What a journey today. We started with the fundamentals, what retained earnings actually are, how profits build them up, how dividends draw them down. Then we dove into the trickier parts, those adjustments for past errors, understanding why they hit retained earnings directly. We also explored those crucial restrictions, legal, contractual, internal, that tell you so much about a company's constraints and plans. And finally, we zoomed out to see the big picture with the statement of stockholders' equity, putting retained earnings in its proper context alongside common stock, APIC, and everything else.
And I think the key takeaway here is that once you understand these statements, you're looking at so much more than just the bottom line profit number for the year. You're actually reading the company's financial history, its track record of decisions, its commitments, its strategic signals for the future. It's pretty revealing stuff when you know what to look for.
Absolutely. So here's a final thought to maybe mull over after this deep dive. Given all these factors we discussed, not just profit and dividends, but errors, restrictions, stock transactions that can shift retained earnings and overall equity, what might these statements reveal about a company's strategic foresight, or maybe even its past financial integrity that you just wouldn't catch from the income statement alone? Something to think about. We really hope this session has demystified these statements and given you that shortcut to being better informed. Keep exploring, maybe pull up a real company's annual report, or head over to farhatlectures.com for more practice and deeper dives. Thanks for joining us on the deep dive. Until next time, keep digging.